Netflix set to report earnings today, and investors are anticipating how much the streamer is prepared for the Hollywood strikes and the performance of its password-sharing crackdown. Joining us right now to talk about it, Michael Nathanson is SVB, MoffettNathanson, founding partner and senior research analyst. Good morning to you. What are you expecting, and what are you looking for, my friend?
Well, we're expecting a big quarter out of these guys. They had prepared everyone to expect a lot of churn when it came to password sharing cracking down, and it looks like that hasn't been the case. They've been very gentle about it. So I think we're expecting the U.S. to actually post net growth this quarter. And I think a lot of us heading into the beginning of let's say May and June, expected negative subscriber growth. So I think there's a real change in sentiment. I think the ad story is going to be really positive. I think the strike plays to their advantage. I mean, I've not been a Netflix bull, but the setup for this quarter for the next 12 months is incredibly strong. And
is that on a relative basis to the other media companies, or is that just pound for pound, given where they are?
Yeah, it's a good question. I think relative, clearly, right? You had Bob Iger on your air last week. I've never heard him sound so bearish, right? The backdrop for traditional media is really tough. So our investor base is looking for ideas in media, and there are very few to feel good about. I think more broadly, when we look at other big cap tech stocks, this one has run more than it probably should. But our investors who look for classic media and telecom, this is the one to own, right? So it's relative in my mind.
Right.
But again, the narrative is so strong in the next 12 months that it's a momentum-driven stock. It's just going to keep moving, I think. I really do.
Is this a game, Michael, where you just have to outrun the tiger and relatively winning is a good thing? Or is this a game when you get into the writer's strike that everybody could suffer if consumer habits change and consumers find something else to do with their time?
Again, that's a great question. I think the risk would be for linear networks that are tied to scripted content, not CNBC. The risk is that people change behaviors about how they watch traditional broadcast. I think what Netflix has that no one else has is that international production of content. And we've said it's a lot like automobile unions, right? That if the U.S. experienced troubles in car manufacturing, international cars would take their place. I think Netflix has such an advantage in their scale of global production that I see them taking share, much like the pandemic in the beginning, where they just took a ton of share. So I think the problem here for the strikers, it's going to make Netflix stronger and their competitors weaker, which doesn't help them in the long run.
Hey, Michael, let's just talk about the calendar, because there is a big question about how long, and Barry Diller made this point on Face the Nation over the weekend, this sort of vicious cycle that could start. The question is, when does it start? There's a view among, I think, a lot of the media executives that right now, up through Labor Day at least, everybody feels quite fine about things. The question is, are they fine if you get to Thanksgiving without new production? Into what that looks like into 2024? Does it create an environment where subscribers really do start to peel off some of these services, and therefore you now have less income coming in the door that you want to use for that new production? How do you see sort of the timing of this play out? Because right now, some of these folks actually think, I hate to say this cynically, that it's to their benefit, actually.
Well, they're all going to put up very big cash flow numbers, right? Because they're not spending money on anything. So, hooray for cash flow. But I think you get to Labor Day without these strikes being settled, and I get really worried. I get worried about the theatrical slate and the ability for talent to promote their slate. I get worried about new shows on streaming, ex-Netflix. I get worried about broadcast coming back. I think it's really damaging. And if this thing goes on, you said Thanksgiving. That'd be.
What's a deal? Like, if both sides are feeling extreme pressure, what's a deal look like? Because they seem like they are so far apart right now.
Yeah, Becky, and I think I've been saying it's a bit like class warfare. The unions see the wealth generated by the executives in this industry, and they're really angry about that. And I think it's really emotional, right? I would say to your questions, by Labor Day, you basically need to come to the table. The settlement has to be that the creators get paid more for streaming residuals, streaming royalties. They have to get paid more. They have to get paid more for international. But the business ex-Netflix is so unprofitable that it's just another cost for these companies to bear. So the problem is this is a strike over real issues. Even though there's a lot of emotion, there's real issues here. And there's not a pot of gold sitting in the media companies, closets where they can easily pay these, the talent, but at the same time, they have to do it because the models have changed so much. So, the directors settled pretty quickly. I think the problem here is you have so many union members who are angry and not working that they're going to dig in for a while. They really are. So it's very worrying for me as an analyst. I'm sure for you guys who observe the sector and care about the sector. If this thing goes past Labor Day, it's a real problem for these companies.